Okay, let's dive right into this. If you are a real estate investor looking to organize your fourth quarter tax prep for a Kansas City rental property, you are in exactly the right place. Welcome to this explainer. We are going to build a really clear, data-driven plan for your 2026 filing so you can approach tax season with absolute confidence. No stress, just a solid plan. Before we jump into the numbers, just a quick heads up that this explainer is strictly educational content. It is definitely not legal or tax advice for your specific situation. Today, we're drawing our insights from Alpine Property Management, Kansas City. They've been a super trusted partner serving investors in the metro area since 2013, and their data provides a really practical focus on the real-world differences between Missouri and Kansas real estate. Here is our roadmap for today. We will be hitting the tax prep pivot, gathering core documents, mastering Schedule E, navigating the state line, maximizing deductions, and finally, deadlines and next steps. I can assure you, following this methodical checklist will bring total order to an otherwise chaotic process. Let's get going. Section 1. The tax prep pivot. April chaos versus Q4 calm. Let's start by acknowledging the very real anxiety out-of-state investors face when tax season rolls around. Honestly, why wait until late March to open a literal shoebox of crumpled receipts and try to reconstruct a year you've already stopped thinking about? It's a great question, right? If you own a Kansas City rental, but you live in Denver or Austin or the Bay Area, trying to piece together invoices in the spring is an absolute nightmare. Fixing mislabeled repairs and gathering missing invoices right now, in December, gives you a completely clean starting point. Think about it. When your numbers are sorted by property before you even dial your accountant, your CPA can spend their time on high-level strategy instead of just basic data entry. That simple pivot makes your CPA significantly faster and your return a whole lot cheaper to prepare. Section 2. Gathering core documents. The Q4 checklist. So let's shift our focus to the specific paperwork you actually need to build a rock-solid file before making that call to the accountant. Here is your core stack of documents. You are going to need your income records, which means things like gross rent collected, pet fees, and late fees. You'll need mortgage details showing interest paid and escrowed property taxes. You also absolutely must gather operating expenses like utilities or HOA dues, capital items, management and leasing fees, professional costs like accounting or travel, and any closing statements if you bought, sold, or refinanced this year. Now, if you self-manage, pulling all this together quietly eats up an entire weekend. But owners using Alpine's full-service management actually get most of this in one simple exported statement that literally turns a lost month of administrative work into a single highly efficient afternoon, a real game changer. Section 3. Mastering Schedule E, Mechanics of Rental Income. Now, what is genuinely interesting about this is how your core documents feed directly into your federal tax return. Over on Schedule E, your gross rents, operating deductions, mortgage interests, and depreciation all come together. But there are two main distinctions that decide whether a tax return actually holds up to IRS scrutiny. Look at the difference between a repair and an improvement. A repair keeps the property in working order and is expensed immediately in full this year. For example, a patched section of a roof is just a repair. An improvement, on the other hand, actually betters the property. This must be capitalized and depreciated. So, a whole new roof, that is an improvement. Knowing exactly which category your expenses fall into is absolutely crucial. Next up, we have basis allocation. Basically, this means separating the value of the depreciable building from the non-depreciable land before you even apply your depreciation schedules. It is a critical step because only the building depreciates, not the land it sits on. Getting this allocation wrong is one of the most common and, frankly, costly items a CPA ever has to unwind. Why? Because it can quietly understate your depreciation for the entire life of the hold. You definitely want to get that right from day one. Section 4. Navigating the state line, Missouri and Kansas differences. We are now entering what is probably the most complex part of our explainer. These are the specific mechanics that consistently trip up out-of-state remote owners. Let's look at how this builds a clear picture for dual state filers. Rental income is taxed by the state where the property actually sits. So a rental in Kansas City, Missouri generates a Missouri non-resident return, and a rental in Kansas City, Kansas generates a Kansas non-resident return. Missouri uses an income percentage form, while Kansas requires a Kansas Schedule S. But here is the crucial point. Your home state will also tax you on all your income, including that exact same rent. To avoid paying taxes twice on the same money, you absolutely must claim a resident credit on your home state return for the taxes you already paid to Missouri or Kansas. This credit is not automatic, and forgetting it is the single most common dual state error we see. And here is a major myth we really need to dispel right now. The 1% Kansas City, Missouri earnings tax applies to active wages and business profits earned within the city. It does not apply to passive residential rental income reported on Schedule E, so most landlords simply do not owe it. Also, you need to keep in mind that property taxes run through entirely different county schedules. A Jackson County, Missouri bill and a Johnson County, Kansas bill will land on completely different schedules with totally different due dates. You have to keep them separated. Section 5. Maximizing landlord deductions 2025 and 2026 rates. And this brilliantly illustrates the data-driven metrics that make real estate such a wildly tax-efficient investment. Let's start with the number 70. For the 2026 filing season, remember, you are actually reporting the 2025 tax year. The 2025 business standard mileage rate is 70 cents per mile. For 2026 miles, it rises to 72.5 cents. Now, travel for genuine property purposes, like airfare or renting a car to inspect an Independence or Raytown rental, is completely deductible. But please be very careful here. Mixing a vacation into a property inspection practically invites heavy IRS scrutiny. Keep your records pristine and make sure your business trips stay focused purely on business. Next, we have 27.5. This is the baseline straight-line residential rental depreciation schedule in years. Honestly, depreciation is the deduction owners shortchange the most often, but you have some really powerful tools at your disposal to maximize it. For instance, a cost segregation study can break out shorter-lived components of the property to dramatically accelerate your write-offs. Pair that with a 100% bonus depreciation for qualifying property placed in service after January 19, 2025, and your tax benefits can be absolutely massive. Plus, for those smaller everyday purchases, the de minimis safe harbor lets you expense many items under $2,500 per item right away, rather than having to capitalize them over decades. Section 6. Key deadlines and next steps, avoiding costly mistakes. We are bringing the explainer into the final stretch now by focusing on strict compliance and firm calendar dates that you simply cannot miss. You'll want to mark these dates on your calendar. By January 31, 2026, your 1099 recipient copies are due. If you operate a rental as a trade or business and pay an unincorporated vendor $600 or more, you generally need to issue them a 1099. Now, when a professional manager runs the property, this vendor payment reporting is often handled for you, completely removing a major deadline from your schedule. Then, by April 15, 2026, your federal and both your Missouri and Kansas state returns are due. And please remember, filing an extension gives you more time to file your paperwork, but definitely not more time to pay what you owe. Missing an estimated April payment is exactly how a highly profitable year turns into a painful penalty. At the end of the day, a tidy Q4 folder is the absolute cheapest tax move you will make all year. Being proactive prevents capitalization errors and ensures you capture every single dollar of depreciation available to you. So I will leave you with this. Ask yourself, is your current end-of-year routine actively building your wealth, or is it quietly leaving thousands of dollars on the table for the IRS? For help managing your Kansas City rental property, call Alpine at 816-343-4520 or visit alpinekansascity.com.